Finding a safe double-digit dividend yield in today's market is extremely hard to find. And if you do find one, you need to be really careful because you may actually be mistaken. And it's actually not a great dividend stock and it could turn into a disaster. In this video, I'm going to share two stocks that currently pay 10% dividend yields or higher. And unlike most ultra high yielding stocks out there, they actually have strong fundamentals to back them up. Most high yielding stocks look tempting, but they come with serious risks: dividend cuts, declining stock prices, and even in some cases, bankruptcies. However, the two investments I'm sharing today are structured in a way that helps protect their cash flow and sustain their payouts over time. So if you're looking for passive income that doesn't keep you up at night, this video is for you. But first, if you enjoy deep dive research into dividend investing, make sure to smash that like button and subscribe for more high yielding investments. Thank you very much. Okay, so first I'm going to discuss why most high yield stocks are actually traps. In fact, most times when a stock pays a high yield, it's almost always too good to be true. For example, if you've ever seen stock paying 12%, 15%, or even in some cases like 20%, you've probably asked yourself, why isn't everyone buying this stock? Well, there's usually a reason. A yield that's high usually means one of three things. Either one, the company's in financial distress and might be cutting its dividends soon. Two, the stock price has collapsed, which is artificially inflating the yield. Or three, the business model is unsustainable and management is just trying to attract investors with a high payout. Let me give you some recent examples. NextEra Energy Partners, which has since changed its name and now goes by the ticker symbol XIFR, they recently not only cut their dividend, they actually completely eliminated it. And before they cut it, it was yielding over 20% and had a very impressive dividend growth track record. And what happened there was simply the fact that the balance sheet had become way over leveraged. They had massive equity obligations and debt obligations coming up, and their payout ratio was near 100%. And so rather than simply cutting the dividend to try to put it on a more sustainable path, management decided to completely rip the Band-Aid off, completely eliminate the dividend, and completely change their approach to capital allocation to now where they're retaining all their cash flow, using it to pay down their equity and debt obligations in the coming months. And ultimately, they're going to be, if they get to a point where they deleverage, they said that they're probably going to lean more towards buybacks rather than dividend payouts. So investors who bought that stock looking for a high and growing yield are now completely burned and have no hope of receiving a dividend anytime soon. Another recent example are some mortgage REITs like Golub Capital and AGNC Investment. These stocks, they pay high dividends, but they're very heavily leveraged and exposed to interest rate volatility. As a result, when interest rates move against them, their dividends inevitably get slashed. Another opportunity that sucked in a lot of investors was Zim Integrated Shipping. It's ticker symbol ZIM. And this stock was paying out over 50% dividends in 2022, so just a few years ago. But as soon as shipping rates fell, their dividend evaporated. That being said, the two 10% or higher yielding stocks I'm going to share with you today are different. They belong to sectors that naturally produce high yields because they, one, avoid corporate income taxes, meaning that more cash flow is left over to pass on to shareholders. Two, they have long-term contracted cash flows, making them much more stable and being able to pay out their distributions on a more stable basis. And three, they are required to pay out most of their earnings as dividends. So let's get into the first stock. This first stock is a master limited partnership that operates in the energy infrastructure sector. And as such, it issues a K-1 tax form. So if K-1 tax forms are not for you, sorry, this pick may not be for you, but please stick around to the next one because it does not issue a K-1 tax form, I promise. So this sector is perfect for high yield investors because MLPs, one, they own essential infrastructure like pipelines, terminals, storage assets that are needed in the energy supply chain. Two, they have long-term contracts with customers, making their cash flow very predictable over time. And three, they get tax advantages, which allow them to distribute more of their cash flows to investors. So what MLP is this one? It's called Delek Logistics Partners. It's ticker symbol DKL. And it currently has a distribution yield of a little over 11%. And it's expected to continue growing moving forward at a rate that's roughly in line with inflation, probably about 3% annually is what analysts are expecting. Now here's why I like it. First of all, it has had very consistent distribution growth over time. In fact, it's increased its distribution now for 47 consecutive quarters. That's a long track record, especially given that it operates in a volatile sector like energy, and it shows that management is very committed to consistently not only rewarding unit holders, but rewarding them in an increasing manner. Two, it also has pretty strong balance sheet. It's been working hard to reduce its debt leverage and is approaching its target long-term leverage target of 3.5 times, which is among the more conservative in the midstream sector. Third, it has quality assets that are heavily contracted. So unlike oil drillers or other energy production companies, this company does not rely on commodity prices. Instead, it earns money from long-term agreements with high-quality counterparties. It's also working hard to diversify its counterparties to make it less risky. It's recently added some very high-quality assets. It also recently had a blend and extend agreement with its largest counterparty, Delek US Holdings, which is up for up to 7 years, so it greatly increased its cash flow visibility from its assets. Fourth, it has attractive growth prospects. It currently has several growth projects underway that it expects to come online throughout this year that should significantly boost its cash flow. It also has numerous opportunities to pursue additional growth in its assets, especially because it operates in the Permian Basin, which is one of the most prolific and attractive energy production basins in the whole world. As a result, analysts actually expect its distributable cash flow per unit to grow at a 13.6% CAGR through 2028, meaning that's not just a high yield stock, it's actually a growth investment as well. That being said, this stock is certainly not without risks. It does have a little bit higher leverage than some other companies in the midstream space like Enterprise Products Partners, MPLX, and others that I like a lot. It also, its largest investor still holds a significant ownership stake in DKL, and that's Delek US Holdings, which also happens to be its largest counterparty. And so it's very beholden to DK, which puts it at some risk that there could be some conflict of interest there that could go against DKL unit holders. Additionally, its coverage ratio has recently got a little bit tight. It's about 1.1 times, and so they had to grow their distribution at a very slow, it's less than 1% pace this past quarter. That being said, they do expect these new assets to come online throughout the year. They're nearing their leverage target. And so for those reasons, it should not be a high risk distribution because it's going to restore it expects to restore its 1.3 times coverage ratio by the middle or later half of this year. But if somehow there are speed bumps on the way to those growth projects or some other unforeseen events come up, there could be risk to the distribution there. But overall, if you can handle some of these risks, some potential volatility, this high yield MLP, in my opinion, is a solid income play and is not at risk of a distribution cut. In fact, I think the distribution is going to continue growing moving forward. Okay, what about the second 10% plus yielding stock? Well, it's a business development company. Now, the good news here is BDCs, they issue 1099 tax forms, not K1s. So that's a little more friendly to most investors. And first, let me discuss what a BDC is, because some of you may not be familiar with it. BDCs are basically banks for small businesses. They lend money to private companies that don't typically qualify for traditional financing. And so that means that BDCs tend to be a little bit higher risk in terms of the loans that they make. That being said, they often get senior secured positions in the capital stack. These are actively managed portfolios by usually very experienced seasoned lenders. They have very diversified portfolios, typically with dozens, ideally even hundreds of individual companies in those portfolios. And so you're really investing in a diversified mutual fund of floating rate, short-term loans to middle market companies. And that can typically get you, very attractive risk-adjusted returns, especially when the underwriter is skilled at managing the portfolio. Now, BDCs are required by law to pay out at least 90% of their income as dividends. And in exchange, they do not have to pay any corporate income tax. And so this is often why BDCs pay very high dividend yields. But here's one that makes this BDC in particular quite special. And to do away with the suspense, it's Golub Capital BDC, or ticker symbol GBDC. So what makes GBDC so special? Well, first of all, it has one of the highest credit ratings in the BDC space. In fact, it is one of only 3 publicly traded BDCs that has a Baa2 investment grade rating from Moody's. It's the equivalent of a BBB rating from S&P. Meaning that it has a lower perceived risk profile than the vast majority of its competitors. In particular, its balance sheet is quite strong and its investment portfolio is deemed to be fairly low risk. And this shows up in the fact, which is the number 2 thing I like about it, has ultra low non-accruals right now. Less than 0.5% of its loans are considered to be a non-accrual, which just means that they're distressed in a way. And that's one of the lowest in the entire BDC sector. On top of that, it has massive first lien loan exposure with 92% of its portfolio in first lien senior secured loans. This means that if a borrower defaults, GBDC is first in line to recover its capital. Fourth, it trades below most of its competitors. So it has some peers like Aris Capital Corporation, Blackstone Secured Lending, Main Street Capital Corporation, Hercules Capital, Sixth Street Lending. All these peers trade at much larger premiums to net asset value, many of them 20, 30, 100% premiums to their net asset values, while GBDC trades virtually in line with its net asset value right now, despite historically trading at a decent premium of up to even 10% fairly recently. So with GBDC, you're getting a strong risk managed BDC with a 10% sustainable base dividend yield and often supplements that with additional dividends on top of that without the high premium of some of these other names and adequate dividend coverage ratio. And so I think that this dividend is quite sustainable. So to recap, finding safe double-digit yields is not easy. In fact, the vast majority of them are going to lead you to sorrow and ruin. But these are two cases with DKL and GBDC, one in the MLP sector, one in the BDC sector, that I think offer attractive fundamentals, solid balance sheets, solid outlooks for the business, tax advantages, and stable cash flows, and what I believe is a sustainable base dividend for each of them that's 10% or higher. So let me ask you, which one would you invest in? Or do you have another high yield stock on your watch list? Let me know in the comments below. And again, if you found this breakdown helpful, please smash that like button, subscribe for more high yield investing insights. See you next time. Thank you very much.